Hong Kong. Let's get to currencies and talk about treasuries first. U.S. treasuries have had their worst first-half loss in 30 years. For more on this story, let's bring in our Forex reporter. We have Trish Louis. He joins us from Singapore. Trish, tell me about the disappointment in 30-year treasuries.
Well, Susan, the Treasuries definitely have lost their safe haven status this year as concerns about the ballooning budget deficit, the record-sized debt issues and quantitative easing, not to mention ratings downgrade fears, all took its toll on the U.S. securities. Now, Treasuries are down 4.4% this year, according to the Merrill Lynch Treasury Master Index. Now, this is the biggest slump ever since Merrill started the index in 1978. Now, that's a world of difference compared to what we saw last year when Treasuries actually handed investors a 14% return as the global economy headed into a recession. Now, aside from the oversupply and ratings concerns, Susan, the Treasuries also lost its appeal simply because of renewed risk appetite, and investors were interested in the riskier currencies, the higher-yielding assets, as talks of the green shoots in the global economy mounted. And yes, we're talking about the stock market, the emerging currencies, commodities, and even corporate bonds. The Treasuries lost out to all these asset classes. And then on top of that, we have rhetorics from the BRIC countries, especially China, about the value of the U.S. debt and deliberation about possible diversification away from U.S. Treasuries. And so we have a cocktail of pretty seriously bearish factors for Treasuries in the first half of this year. Susan?
Okay.